Hi, everyone. Welcome to Gemini's Intro to Ethereum webinar. Today, the webinar is going to be hosted by me, Matt Tyndall, tech lead for Nifty Gateway, and Matthew Warner, who is tech lead for our wallet team here at Gemini. And so in this webinar, we're going to be learning about what Ethereum is, some of the existing use cases, and the future of the network. And at the end of the webinar, we're going to have some time for a Q&A. So feel free to drop your questions in the Q&A window throughout the chat. And welcome. We're excited that you're here. And before we begin, we'll do some quick introductions. As I said, I'm Matt Tyndall, technical lead for Nifty Gateway, which is Gemini's NFT marketplace, which we'll be getting to later in this webinar. Before Gemini, I was working as a smart contract developer at Consensus and have been working within the Ethereum ecosystem for about 4 years now.
And I'm Matthew Warner. I'm a tech lead on the wallet team at Gemini. I've spent most of my time here at Gemini designing cold storage solutions to safely store large amounts of cryptocurrency. And I've been in the industry for a bit over 4 years, previously working at Coinbase as the head of their crypto engineering department. Most recently, I worked on an upcoming protocol named Definity.
And we've got a brief agenda here that covers some of the topics that we're going to be going over, starting out with exploring some of the differences between Ethereum and Bitcoin, learning a little bit about the building blocks of Ethereum, what makes up the network, and then getting into some use cases and case studies of different types of tokens and applications. And so kicking off, like I said, we're going to start with differences between Ethereum and Bitcoin. And in order to really dive into Ethereum, it can be helpful to have a basic understanding of Bitcoin. Bitcoin being the first cryptocurrency, it really introduced the concept of a blockchain, which Ethereum is built upon. Cool. So is that it?
I think we need to record this one too because the first 2 sentences of this one were cut off.
Damn. Okay. I shouldn't have said anything then.
It's fine. I can totally cut it out.
Yeah, there's a nice long pause in there.
Yeah, don't worry.
So do you want me to do the whole thing, or do you just want to start it out, or what?
Can we do the whole thing?
Yeah.
Okay, thanks.
All right. Gonna give it a go in. All right. To help compare these two networks, we can start by looking at the monetary side. The current price of Ether, the cryptocurrency of the Ethereum network, is around $375 with an overall market cap of around $42 billion. And Bitcoin, on the other hand, is currently tracking around 11,400 with an overall market cap of approximately $211 billion. So you can see that the Bitcoin network is roughly 4 times larger than the Ethereum network. And the market cap calculation is based on the circulating supply of each asset. With Ethereum, there's no specific supply cap. However, there's currently around 113 million Ether in circulation and a yearly issuance rate of about 4.5%. And looking at Bitcoin, we know has a well-defined supply cap of 21 million Bitcoin, and there are currently about 18.5 million Bitcoin in circulation. Looking more into the network speed of each network, on Ethereum, a new block is produced roughly every 15 seconds, whereas with Bitcoin, blocks are produced about every 10 minutes. And so from that, you can kind of see that the overall throughput of the Ethereum network is higher than Bitcoin. Finally, we take a look at the overall goals of each platform. The Bitcoin network primarily supports the ability to transfer value from one person to another without any intermediaries. And it's grown to have a very strong store of value narrative as a hard money or as a deflationary asset. And Ethereum's a bit more complex in its goals. While it does support peer-to-peer value transfer like Bitcoin, its true power lies in its open platform for developers to be able to create and publish decentralized applications that anyone else can use. Another way to frame that is that the Bitcoin network primarily supports a single application, the transfer of value, while Ethereum allows developers to create and publish myriad decentralized applications.
So yeah, as Matt pointed out, Bitcoin and Ethereum are different. They differ in several ways, and I think like a lot of people are familiar with Bitcoin. They kind of get the idea of it, but they don't really know how that's extended into Ethereum and how Ethereum built on top of some of these ideas. And the key difference that we want to look at today is the application row that Matt had in the table. The basic building blocks of Ethereum are referred to as smart contracts, and they're how Ethereum operates. So the primary benefit that Ethereum provides is the ability to execute general purpose business logic within an Ethereum transaction, where Bitcoin supports transfer of balance from one place to another, like one Bitcoin address to another. Ethereum allows for the execution of an arbitrary functionality without necessarily transferring the balance of funds. So this general purpose functionality creates a broad set of possibilities. It's like comparing an ATM to a personal computer. One is built for a specific purpose, and the other is capable of all sorts of different kinds of applications. The general purpose functionality built on Ethereum is referred to as smart contracts, which is just code that is stored on the blockchain and is executed by sending Ethereum transactions to it. So in Bitcoin, all of the transactions are pretty much the same. They specify an amount of Bitcoin, where you want to send it from, and where you're sending it to. In Ethereum, you've got three different kinds of transactions that you'll see. The first is the same kind of thing, simply transferring Ethereum from one address to another, just like Bitcoin. But the second one, you can upload a smart contract, which is that piece of code. And instead of sending a balance of funds to an address, you can store any code you want on an address in Ethereum. And the code remains on that address waiting to be executed. So the last kind of transaction is one where you're able to execute a smart contract on the blockchain. So by sending an Ethereum transaction to an address that has a smart contract on it, you can execute the functionality written in the code, and the smart contract is available to be executed by anyone that sends an Ethereum transaction to it, not necessarily the person that originally wrote it. So after we've written the code and we put it on the blockchain, anyone that wants to can execute that functionality. The contracts functionality isn't being provided by any one company or organization. It's referred to as a decentralized application, or a DApp for short. So as you can see on the top of the slide here, Alice could simply send Bob a 1 ETH transaction, and it's a simple transfer of a balance, and there's no smart contract being used at all. And that's that first type of transaction we talked about. But suppose that we wanted Alice's payment to be allocated between two different people, say 80% to Bob and 20% to Sam. Maybe Alice is making a rent payment and Bob and Sam are the co-owners of the unit. Or maybe Alice contributed to a fundraiser that's distributing the donations between the different people in the group. Or Alice could even be a company that's distributing earnings to her shareholders, Bob and Sam. There's any number of different reasons why you might want to have a little bit more logic involved with moving money from one place to another. And when Alice executes the smart contract, a transaction is sent to the contract's address. It contains all the necessary parameters to tell the smart contract what to do. And Alice needs to provide funds to be allocated and any data needed to complete the transaction. And the contract will split the 1 ETH into smaller amounts and send them out to the correct destinations based on the way that the smart contract code was written. And in this case, 0.8 ETH went to Bob and 0.2 ETH went to Sam. So as people started writing these smart contract and applications on Ethereum, some common patterns started to emerge in the applications that the developers were writing. And one of the most common types of smart contract is one that creates a specific set of functions that fit a specific standard interface that everyone agreed upon. A smart contract that includes these specific functions is referred to as an ERC20 token. The name just means that it was the 20th proposal for a change to the Ethereum protocol. ERC stands for Ethereum Request for Comments. So it's just the 20th number of the change proposal. So ERC20 standard interface includes functions to create and interact with a new currency separate from Ethereum, all within one smart contract. I'll just say that again, because the first time that I heard it, it was kind of crazy. Like, there is a ledger within one smart contract that provides the ability to create a new currency within Ethereum. And these currencies are referred to as tokens. The ERC20 standard describes the way that you send, receive, create, and destroy these tokens so that every one of the tokens that are on Ethereum behave the same way. And they kind of, you can use the same function call on one smart contract for an ERC20 as another. And the smart contract itself stores a ledger of any Ethereum addresses that have a balance of that currency. So by introducing tokens, smart contracts are then able to incorporate these balances into any additional functionality that they've written in their smart contract or dApp. And this opens up all sorts of new interesting applications. So I just checked yesterday, there's currently about 1,000 ERC20 tokens that are being traded somewhere on the internet. And to really get our head around how some of these tokens work, let's look at some of the examples of like common use cases and case studies for how they've been used so far. The first are stablecoins. You may have heard of them before. Stablecoins are an ERC20 token that are supported by a government-backed currency. So this could be dollars or euros or yen or any other fiat currency. There are ways to do them in a decentralized way, using like a basket of different assets that support the value. But those are a bit more complicated. And for the sake of understanding how the ERC20 interface works, stablecoins are a great option because, say in the case of US dollars, every time someone deposits $1 into the smart contract creator's bank account, that stablecoin mints that many new stablecoins and allocates them to the depositor. So if I say I wanted to mint some new stablecoins, I can send dollars to someone's account and they send me stablecoins of that dollar back. These stablecoins can be transferred just like any other token, and they give the holders the opportunity to keep their balance stable and pegged to the government currency they deposited without leaving the cryptocurrency space. They can still have all their assets and total value held on a blockchain. And any token holder can redeem those tokens with the issuer, even if they weren't the ones that minted those tokens themselves. So they can go and provide these tokens to the issuer and receive their original currency in return. And when these tokens are redeemed, the corresponding tokens are destroyed or burned, as they call it. And that keeps the total number of tokens in circulation always matching 1-to-1 the number of dollars held in the account. Another project that's really interesting is the OXT token for the Orchid protocol. And OXT is a token you can send and receive just like stablecoins, but the difference here is that the OXT smart contract provides additional functionality or utility in addition to creating and destroying and transferring tokens. So they have all the ERC20 functionality, but in addition to that, they have some specific functionality that they make use of that token for. And the Orchid project provides a VPN client that's able to accept the OXT token as payment. A VPN, for those that aren't familiar, stands for Virtual Private Network, and It allows you to route all your internet traffic through the service provider, and can be good for a whole bunch of different reasons. But generally speaking, if you have a VPN provider that wants to accept OXT, they can sign up and they can get matched with your client and can receive OXT for payment through the smart contract. And they provide those VPN services to anyone that has the OXT token and is willing to pay with that. And if you compare this to traditional VPNs, if I wanted to go get a VPN today, I'd go and have to select a VPN and give them my payment, my credit card information, and probably get a monthly subscription or a yearly subscription. And then I'm like on that VPN. And with OXT, because you have the payment currency right alongside the functionality to find the VPN provider, it's a lot more fluid, and it's a lot easier for you to, say, give me a VPN provider, whichever one is willing to give me a good rate, or you can say select from this group. And it accomplishes this in a decentralized way without you having to choose one centralized provider. So extending this idea of decentralization a bit further, there's a project called BAT, or the Basic Attention Token. And by accompanying the protocol's functionality with a token, you open up entirely new business models that can run more efficiently than traditional systems. One of the first use cases that we saw was an ERC20 that came out in 2017. BAT, or Basic Attention Token, creates a closed system between content producers, advertisers, and users. So if you're reading a blog post and you see an ad, you are the user. The person that wrote the blog post is the content producer, and the advertiser has their placement there to try to get your attention. And traditionally, companies like Google built advertising platforms to allow content producers to earn revenue by showing ads to users. And this usually comes in the form of print ads on blog posts or pre-rolls before videos. And the BAT token removes the need for this third-party platform. Instead, if you use a browser like Brave, which I use, it's just like Chrome, users can pay the content producer BAT directly to view the content within their browser. So you know that your money is not going to PayPal or Venmo or Visa. It is the token transferring peer-to-peer to the content provider and content producer. And if you prefer to view the content for free, the browser displays an advertisement and the content producer is paid BAT by the advertiser instead. So users can also opt in to view additional ads, and they could earn BAT from advertisers directly. This idea of disintermediation, or removing the intermediary like Google's ad platform, keeps the value exchanged between the parties directly involved, rather than allowing a third party to siphon some of that value out of that closed system. This is made possible by the Ethereum blockchain processing transactions with a native token associated with the advertising functionality. Disintermediation is a huge driving force between the reason why people are really interested in cryptocurrencies, and new models like this one are made possible with the idea of smart contracts.
Awesome. So that kind of gives us a little bit of an overview behind ERC20 tokens. We're now going to kind of jump into some of the other interesting things happening within the Ethereum ecosystem. And there are two areas that are really popular right now that we wanted to cover, and that's decentralized finance, or DeFi, and non-fungible tokens, or NFTs. And so we'll start with DeFi, and DeFi is really just a subset of decentralized applications that promote open financial infrastructure. So there's not really any specific qualifications that make an application or a product DeFi, so to speak. It's more of a loose term that sort of covers a wide spectrum of applications. But in general, many of these applications focus on the ability for users to lend borrow, and trade in a permissionless way, where users can basically just plug into the application with their Ethereum wallet and begin interacting directly with the underlying smart contracts through a web interface. And some notable examples of DeFi applications you can see here on the slide. MakerDAO, it's a system of smart contracts that enable users to lock up crypto assets as collateral and issue a stablecoin backed by those assets, basically enabling anyone to issue themselves a loan. Another one is Uniswap, a protocol for exchanging ERC20 tokens through an automated smart contract market maker. And then we have Compound, which is a protocol for pooled lending and borrowing. And there's many others. These are just some quick examples that are pretty popular. And I also noted next to those items, the TVL, which is sort of the total value locked in those protocols. So just to give you an idea of how large the emerging DeFi ecosystem is, we're talking billions of dollars locked into these projects. And one of the other really interesting aspects of these DeFi applications is the fact that once they're deployed, they can operate somewhat autonomously without much intervention. While many of these applications have dedicated teams and companies behind them, the eventual goal is to turn over the functionality directly to the end users of those protocols through the distribution of governance tokens. And these tokens can come in many forms. They're generally all ERC20 tokens, like we covered before. And they have a number of different use cases. And some of those include the ability to vote on adding a new token support to a decentralized exchange, increasing or adjusting the interest rate in a lending protocol, or even implementing a protocol fee that goes directly to the governance token holders. So there's a lot of reasons why you may want to own governance tokens for a particular protocol that you or your business frequently uses, or even for speculative purposes, as the ability to govern many of these tokens has its own inherent value. And to highlight an example of that, I've chosen Compound Finance, which really sort of encapsulates a number of those ideas. Compound Finance is a decentralized lending protocol where users can deposit assets, earn interest on those assets, and use those assets for collateral, which they can then use to borrow other assets. And to further break that down, you can go to Compound's website with your Ethereum wallet in your browser and begin interacting with the protocol without any sort of sign up or authorization from Compound Finance. Rather, the smart contracts of the Compound protocol define what users can do. And additionally, if you're a developer, you can begin to integrate with Compound's protocol directly, again, without any sort of authorization or approval. And it makes Compound both a product and an infrastructure for decentralized lending. And so digging deeper within the protocol, the lending rates are automatically adjusted in real time based on the demand for borrowing those assets, which makes the system completely autonomous. Users deposit tokens into the Compound liquidity pools, and the protocol keeps track of what they've deposited and how much interest they've accrued. On the other side, as a borrower, the protocol tracks collateral positions and can automatically liquidate a borrower who fails to maintain a specific level of collateralization defined by the protocol. And there's a number of reasons why someone may want to do that. In the case of borrowing, a user may want to build a margin position and borrow stable coins that they can use to purchase more of that underlying asset that they're looking to create a position in. Or in the case of lending, a user may want to earn a return on stable coins that they have sitting in their wallet, and will deposit them into Compound to sort of earn a sort of passive income. And then one other area to focus on is that the Compound protocol actually distributes users of the protocol comp tokens, which are the governance tokens for the Compound protocol. And so rather than having a centralized team dictate the product roadmap and all of the sort of configurations for the protocol, new requests are put to a decentralized vote and decisions are made on chain. So, theoretically, this is a more equitable, more fair way to sort of govern a protocol. And anybody who has comp tokens can participate in that voting. And so, that's a very brief kind of overview of some DeFi protocols and the ideas behind DeFi. We're going to pause the discussion there and kind of jump into the next section. But if you have any questions, feel free to drop them in the chat, and we'll get to them at the Q&A portion. And so that brings us to the next section, which is non-fungible tokens, or NFTs. And NFTs are really interesting. The whole idea sort of comes from the fact that not everything makes sense to be bucketed together or accepted one-to-one. You have many real-world assets that have unique properties that may not allow them to be sort of exchanged one-to-one, and that's also true of digital goods. And so that's where the idea behind NFTs comes from. And so, like ERC20 tokens, NFTs follow a standard protocol. It's ERC721, and that defines their functions and enables the compatibility of them across the Ethereum ecosystem. And there's a number of popular use cases for this, and these are just a couple of categories here. But art and collectibles is a really strong area that's growing quite a bit, and it's the idea of sort of allowing artists to create these digital originals and prints of their pieces released as tokens for people to buy and collect, as well as the idea behind digital trading cards as another example. You have game items such as in-game weapons, skins, and achievements, which all sort of naturally lend themselves to the idea of being tokenized. And then finally, you have financial products that maybe don't fit into the sort of standard fungibility that the ERC20 token provides. And these are things like insurance, digital identity, licenses, and things like property or deeds. And we're going to touch a couple of these examples here, starting with art and collectibles. Art and collectibles are currently one of the most popular NFT categories. And as I said, they're getting a lot of traction, and you're seeing a lot of organic growth in this area. In short, NFTs enable true ownership of digital creative works, which is something that really hasn't been possible before. If you think about the idea of downloading an image on your computer, there really hasn't been the ability to capture value for the creator of that image because there's nothing that sort of provides the ability to really own that or govern the way that it's sort of issued. And as an artist, you can now release a digital artwork which has a built-in cryptographic signature, proving its authenticity, as well as demonstrating the scarcity of that particular asset. And since these assets exist on chain, you can view the entire provenance of the work from initial release to the artist to any sort of secondary market sales that have occurred. And you can always kind of view who the current owner of that item is. And, because these things are natively digital, it opens up a ton of new possibilities for ways to actually create this art and kind of new mediums for that. You have the ability to have animations, sounds, 3D elements. But even going further than that, you have the ability to sort of change what the art behind those items are over time. And you can kind of imagine there's sort of limitless potential to the ways that you can come up with ideas that you can encapsulate in an NFT. And there's sort of, on the collectible side of that, there's sort of the parallels between things like collecting Pokemon cards or rare Jordan sneakers. So there's a sort of dynamic for collectors that's sort of similar to that. And naturally, that sort of brings up the idea of NFT marketplaces and Gemini's own NFT marketplace called Nifty Gateway. And at Nifty Gateway, we strive to provide high quality NFTs through a curated selection of artists that we work with. Every week, we release new pieces through drops where artists can sell a limited quantity of pieces for a set price or through an auction. And then after the drop, collectors can go to the secondary marketplace, make offers on pieces that they missed out on, or put pieces up for sale. And additionally, one of the really interesting aspects of this is that artists can be compensated for secondary market sales of their pieces. So if somebody decides to sell a piece later on and it goes up in value, the artist will receive a portion of that, which is something that is really exciting to these artists. And additionally, you know, there's a lot of hype in this area, and a lot of these collections sell out. You know, even some of our wildest expectations have been exceeded with some of the sales that we've seen on the platform, and a couple of notable auctions that have gone for quite a bit of money are also noted on the slide here too. The next area related to NFTs would just be with games. And, you know, this is sort of maybe more of a casual use case for the blockchain, but it's also, you know, very growing and very prevalent in the NFT space. And you may have heard of CryptoKitties, which is a sort of collectible digital cat game. It was one of the earliest, I would say, NFT games on Ethereum, and it really sort of pioneered the idea behind the ERC20 token. Another example is Gods Unchained, and it's a digital collectible card game. It's similar to the wildly popular Hearthstone, except that all of the cards within Gods Unchained are actually NFTs. And so as a player, you can earn those cards by playing the game, and then you can also buy and sell them on an open marketplace. And so, you know, that kind of wraps up those two sections that we wanted to talk about. There's, you know, a bunch more that could be covered, and a lot more happening within the space. There's definitely things that we've omitted, and if there's something that you're curious about, again, feel free to drop a question and we'll get to it in the Q&A section. But in general, there's a couple of things that are happening in the space that are kind of coming down the pipeline and are worth talking about a little bit. And one of them is this idea of money Legos, which is something that sort of you see people on Twitter mention in the DeFi ecosystem. But it's just this idea that as we sort of build these pieces, these different protocols on Ethereum, you can sort of combine them to build new things from that. And it's this idea of what's called composability that is one of the reasons why the Ethereum network effect is so strong and why so many developers choose to build on it. Again, the ERC20 and ERC721 NFTs are the first kind of major token standards to emerge, but there's a number of additional types of tokens and token use cases on the horizon. Included a couple examples here, things like the tokenization of real estate, the idea of taking REITs and providing fractional ownership through tokens. There's the concept of tokenized identity, where a government agency could issue a form of identification through a token. And Switzerland, for example, has been experimenting with that idea a little bit. And then finally, the idea behind tokenized securities, where basically you could put stocks and equities on the blockchain. And those are all things that are maybe a little bit further out, but are definitely things that people are working on and exploring as well. And that sort of wraps up the intro to Ethereum for this presentation. I guess some of the key takeaways that we wanted to mention are just the idea that Ethereum is really a platform for decentralized applications. It has a strong network effect from the interoperability of the smart contracts on it. DeFi and NFTs are two emerging ecosystems within that of many. And Ethereum continues to be the leading platform for token. And one other thing that we wanted to mention is that we have a kind of a cool promo going on right now. So anybody who places an ETH trade of any amount on Gemini within the next 48 hours will be entered into a chance to win a full ETH credited to your Gemini account. And it seems like the value is going up as we speak. So it's a fun little promo that we have there. And we'll be picking the winner on Friday. And that brings us to the Q&A. So I I guess we have a couple of questions here that we can take a look at. I don't know if you want to take one, Matt, and I can
Sure.
take a look at the list as well.
Yeah, so I'm just going to start at the top. There's a lot of really great questions in here. Just kind of go from in the order that they were received. So let's see here. How does comp compared to Aave? Is there any difference? So the governance tokens that Matt mentioned, comp and Aave, represent the tokens that are allocated to people that participate in the DeFi protocols Compound and Aave. And the DeFi protocols are smart contracts that allow for these different financial services to take place. And they issue out rewards or issue out liquidity tokens in the form of governance tokens, Comp and Aave. So you'll have Uniswap tokens, you'll have it's very fashionable to have a governance token associated with the DeFi protocol that you're participating in. And that's generally the reason why you'll see those different tokens. I see there's another question very similar to it right below that. It says, like, to participate in DeFi, is it enough to simply own those tokens, Comp, Maker, Aave, or must you actively lend in order to reap the benefits of DeFi? So it all depends on what you're trying to do. A lot of these governance tokens are seeing growth in secondary markets and on exchanges. So if you believe in a DeFi protocol, it's going to get a lot of use and you think it's a great project, you can just speculate and purchase a bunch of their governance token and expect it to grow as people use it more. But if you have a lot of cryptocurrency that you want to lend out and earn interest on, you can just provide liquidity to these protocols and earn the governance token that way. And it all depends on kind of what your situation is, but you don't have to own the governance token to participate, and you don't have to lend in order to participate.
Yeah, and I'll just add that, you know, with many of these DeFi protocols, there are some similarities across platforms, and, you know, it is a sort of competitive market ecosystem where there's different protocols that are sort of competing for having the most liquidity or the best interest rates. And when you take a look at the actual like protocols, there's also differences there as to sort of the way that they operate and the sort of conditions that they sort of subscribe to. And so when you're evaluating these things, you can kind of look at a number of things. The price of the token, it may be sort of disconnected from the actual like elements of what differentiates that protocol from others. But in general, one of the really exciting things about DeFi is that a lot of these protocols and teams and companies that are working on this stuff are learning together in real time. So as one protocol sort of introduces this new breakthrough, you'll see other protocols begin to adopt that or try to include that or figure out a way to be able to kind of incorporate that into their protocol as well. I saw one question here, which was, would you say the mainstream uptake of dApps is tracking ahead or behind your expectations, and why? And I think this is kind of an interesting question. But in general, I think, you know, the crypto ecosystem is early, and I think people have been saying that for, you know, about a decade. But at the same time, it's still kind of true in the sense that, especially within the Ethereum ecosystem, the ways that you can interact with dApps has been a pretty large barrier to entry for a long time now. You have to have like a fairly technical understanding of how these things work. And it's up until recently, there hasn't really been a way to necessarily interact with these protocols without having an understanding of smart contracts and things like that. I think that that's changing, and I think that with a lot of these DeFi protocols in particular, you're starting to see these really impressive web interfaces that really sort of take the elements of, hide the elements of blockchain to the end user, so that they're, you know, interacting through these sites in the way that you would expect to interact with any other site. And there's obviously some differences because you're kind of interacting through your own wallet, and that sort of provides this interesting different dynamic. But the user interface for these things has definitely come a long way. And I would say, you know, as an engineer who's working in the space, it always is sort of tracking behind my expectations of where things should go. But that's just sort of the way that it works when you're dealing with these new technologies. It takes time to kind of roll out, and the other side of that is that as time goes on, a lot of the sort of frustrating aspects or bugs and things like that get worked out by the early adopters, the technical people, so that by the time that it does sort of come to the mainstream, it's a lot more polished and a lot more accessible and usable.
Yeah, I think I've to extend on Matt's point, I've experienced you know, several different breakthroughs in use cases on Ethereum, and I remember in 2017 I was buying ICOs that I had to read the text file in GitHub to figure out how to do it in the terminal, and it was just like really scary for me. And I'm fairly technically savvy, but now you can just pull out your iPhone and like send some money into Uniswap, and you can trade one ERC20 token for another for, you know, cents on the dollar. And it was like, that's a great experience. And it's amazing how far we've come with these things.
Definitely.
I can pick up one real quick. There's one in here about what the use case for a borrowed token is. Like, why do you want to borrow tokens? The same as legacy finance, where you can either leverage your position if you want to reinvest, and that's called like margin trading, or if you have a lot of Bitcoin and you want some stable coins, but you don't want to sell your Bitcoin, you can loan that out as collateral, and you can take out a loan in stable coins and do whatever you need to with that. And so there's a lot of different reasons why you might want to borrow tokens, but it's just like traditional finance.
Got a question here. What are the implications that there is no scarcity with Ethereum as there is with Bitcoin? Is it less valuable long term? And I think that's kind of an interesting question. Like I said at the beginning of this, Bitcoin really has a strong narrative behind the hard money aspect, where there's a set supply and there will only ever be that supply. And I think that really, you know, that is a totally a fine like approach to creating a digital store of value, and it's probably the right approach for having a digital store of value. With Ethereum, the goal isn't necessarily to be a store of value in the same way as Bitcoin is. It's more of the platform aspect of it. And so the way that Ether is used within the Ethereum ecosystem is Ether is really a gas to execute smart contract transactions. And so to that end, it can be used as a store of value, but you sort of need the ability to have a continued new issuance of Ether to be able to continue to operate these smart contracts. And so the idea is trying to find a balance between that, to where the overall issuance is low enough that you don't have this sort of insane inflation that continues to dilute the token value. But at the same time, you have the ability for more tokens to come into existence, so that people can continue to use those to pay for transactions on the network. And it's definitely, you know, an interesting experiment going on in real time to kind of see how that impacts the price and what that does long term. I think in general, though, Ethereum has made a lot of efforts to sort of lower that inflation to a level where it can kind of safely exist, where there is this element of a store of value, but also it can still be able to sort of achieve its goals of being that payment method for executing those transactions.
Let's see, there's a good question here. What will DeFi do to typical lending and mortgage business of traditional banks in the long run? I think it's a great question. We won't really know until we get there. In the same example as the added platform, you really have new models that show up, and there's this whole like premise of disintermediation, where I would have to go to a bank and make sure that the bank trusts that I'm good for the money, and hope that I can convince them to give me the money for a loan. And there's underrepresented people in the world that may have a hard time with that. And I think like that system where anyone that wants to says, yeah, I'm willing to give you that money for a 3% rate or something like that. And you could have a decentralized crowdsourced mortgage loan, which is just something that you don't have today. And if you purchase a house using this, you could tokenize the ownership of the house, and that can be executed through a smart contract that saves all sorts of underwriting fees and people signing various contracts and all these other, this bureaucratic stuff that, it's all speculative, but it just feels like there's a lot of room for optimization there and gains in efficiency. And I think that when you have the token baked into the functionality, it really opens a lot of doors on that front.
And I would just add that, for any sort of traditional finance industry, there's sort of a parallel version of that sort of emerging within the DeFi ecosystem. And so I think that it's certainly getting to a place where the rates can maybe more attractive on DeFi than they are from the traditional standpoint. I think there's still some, inherent risks and some other considerations for people to really understand before you kind of replace all of that existing infrastructure. There's a lot of things that the traditional system does well, but I think the thing that's really interesting is just that, over time, the parallel DeFi infrastructure is going to reach parity with the existing traditional infrastructure. And that's when things get really interesting, because you sort of have this choice where you can choose between one or the other. And as an end user, it might not look any different. It may be the same. But when you're using this sort of DeFi infrastructure, there's a number of benefits to doing that and being within that ecosystem. And I think that a large piece of that as well is just the advent of stablecoins and the ability to kind of have this these units of value that aren't volatile to be used within this space. It just opens up for so many more possibilities. If you don't have the ability to do that, if you have volatile assets, it becomes really hard to really have these actual financial products, because you're constantly having to deal with that price volatility. But the advent of stablecoins kind of opens that up and helps to solve that issue.
So I saw a few questions in here about other chains like Cardano and Polkadot and how they are related. It's important to note that all of the smart contracts and all of the ERCs, whether it's Nifty's or ERC20, all these protocols are all contained within Ethereum. And there are other networks, other blockchains that are completely unrelated that have comparable functionality in terms of smart contract execution or smart contract support. And I think this is healthy for cryptocurrency in general to have competing platforms that can do the same thing. But right now, frankly, there's just nothing outside of Ethereum that has the same level of traction and network effect that Ethereum is seeing right now in terms of DeFi and NFTs as well. So I think there are some other interesting projects, whether it be Cardano, Polkadot, Tezos, a lot of interesting smart contract platforms that are trying to do similar things in a slightly different way, or they have a different conceit on the way that they approach it. And it's great to see that kind of competition and down the line as these things mature, I'm sure you'll see, a landscape of different cryptocurrencies that you can choose from, in the same way that you have a lot of websites you can go to be able to accomplish the things you want to do.
Definitely. I see a couple of questions here related to NFTs that I can kind of maybe try to group together. Let's see, one of them is about the sort of supported file formats for an NFT. And you can certainly, whether it's an image file or a video file, an MP4, anything like that, can all be supported through an NFT. There's a couple other questions related to sort of the copyrights or sort of preventing against forgeries and things like that. And one of the interesting aspects of having a token that exists on a blockchain like Ethereum is that you can see who the original creator of that is. It may just be an address that, you know, looks a little bit, it's not really clear to determine who that is, but as an artist, you can sort of publicly share that this is my address where I'm issuing tokens from, and then anyone can sort of instantly verify that the token came from that address. And if there's you know, somebody who's selling basically a copy or a forgery of that, it's immediately verifiable by anyone to be able to see that, okay, that didn't come from that same issuer. So I know that that's not a legitimate token or a piece from that artist.
So I see a question here that's really interesting, and I just realized we're probably not gonna be able to get to all the questions. It's great to see so many questions, but this one was really interesting. It said, like, could you explain how and why Ethereum benefits from hosting apps? Does the price of ETH go up if there's more dApp activity? And I think, like, it's a really hard thing to get your head around with cryptocurrency, but ETH doesn't care what happens on Ethereum. It's kind of the idea of a decentralized protocol, is that it's this general purpose platform that no one company or organization benefits from people using it more or less. And it's kind of the beautiful thing in it, and that, like, it does what it's supposed to be doing. There's people working on making it better, but it's not this, like, profit-driven, growth-driven kind of a project where it really wants the price of its stock to go up or something. The ETH price might fluctuate based on people speculating about it, or the transaction fees may encourage people to mine new blocks for it. But these are, like, they're all financially invested and interested in participating in the network in different ways. And it's this nice kind of harmony between the people using transactions, the people mining blocks, the developers, all kind of working together to make a system that everyone benefits from. And it's not really like Ethereum that is pushing growth. And I think, like, that's a great part of decentralization, and a big reason why a lot of people believe in it.
Yeah, one thing just to also kind of piggyback on that is that it is difficult to sort of put that the sort of the inherent value of an Ether token compared to the usage of applications on Ethereum. But one thing I will say is that with the explosion of sort of DeFi protocols, Ethereum Ether, the token, represents sort of the most choice collateral option available for those protocols, because it's something that is native to the network. So even if you were to use a different type of token, like a stablecoin, as a collateral, Ether still sort of has the maximum amount of power, I guess, or acceptance within the Ethereum network, just because it is the native currency of the network. So to that end, there is some sort of ways that you can kind of create a valuation framework around that based on the amount of sort of collateral that's being used in DeFi and the types of collateral assets that are being used.
Definitely. Do you see any questions you like?
Just going through here, I think we've covered a bunch of DeFi questions. I'm trying to see if there's anything else that
there's a couple interesting other use cases, like talking through how insurance works, or how transactions could be used in social media. And I think these are interesting, great new use cases that are not the obvious finance trading kind of things. That it does take a little bit more, you know, creative thinking to figure out how they can work. But I know that Twitter is working on their Big Sky initiative, Blue Sky initiative, to be able to figure out how we can use blockchains to transfer data in a consistent protocol. And in the case of insurance, there are Ethereum smart contracts now that allow people to say, I'm willing to cover any problems that come up with these cases if I can receive payment for that. And the protocol handles the exchange between the parties peer to peer. and that the insurance provider puts up collateral to make sure that if something happens, they can apply those funds to the person buying insurance. And this is just the kind of thing where you have to take the existing patterns we're familiar with of either an ERC20 token or a decentralized application and the money Legos that Matt was talking about, and say, how can we add a little bit to this and serve a new use case and provide more benefit that we aren't currently getting? And we're seeing this like year after year. People are finding new ways of applying these things in useful combinations, and it's really cool to see.
And I think that's probably a good place for us to wrap up there. We've definitely covered a lot of ground here. Appreciate everyone taking time to watch this webinar and to ask their questions. There will be a recording of this available afterwards. Just as a reminder, there is that promo. So if you purchase ETH on Gemini's exchange, you'll be entered into a raffle to win 1 Ether. And we'll be picking the winners for that on Friday. So thanks again for joining, and have a great day.